Good morning, my
Good
lady.
morning,
Can you see
Catherine.
us and can you hear us?
I can, thank you very much.
My lady, the first witness this morning is Lord King.
Thank you.
I'd like to stand and take that in your right hand, and then repeat after me. I swear by Almighty God
I swear by Almighty God
that the evidence I shall give
that the evidence I shall give
shall be the truth,
shall be the truth,
the whole truth,
the whole truth,
and nothing but
and
the truth.
nothing but the truth.
I'd like to take a seat.
Thank you for coming to help us, Lord King.
Pleasure to be here, my lady.
Lord King, you are the former governor of the Bank of England, and you were in post between 2003 and 2013. Is that right?
Correct.
You have provided a witness statement to the inquiry with reference number INQ 000656310. You are here to give evidence today primarily about monetary policy and the actions taken by the Bank of England during the pandemic. Yours is an outside view of what was happening because you were, of course, not in post at the time. Is that right?
Correct, yes.
Lord King, we are planning to structure your evidence in two parts today. The first is to give an exposition of some fundamental principles related to both the bank and monetary policy. And the second is to take your perspective, perhaps a critical outside perspective, on the actions taken in respect of monetary policy by the bank during the pandemic. The first question I have for you then, as a building block, the Bank of England is an independent central bank. Why do we have one?
It is independent in respect of the decisions it takes on the operations of monetary policy. It's not independent in respect of its objectives. Those are given to the bank by Parliament after decisions by the Chancellor. So, for example, in monetary policy, the government sets the inflation target, currently 2% a year, and then the Monetary Policy Committee takes decisions to set interest rates or engage in quantitative easing to achieve that target. The reason for having that split between the objectives given to the elected government and the operational decisions given to the bank and its committee is to ensure that decisions on interest rates are taken out of day-to-day political flux and pressures. And before the bank was made independent, there were examples where governments would change interest rates perhaps just before a by-election or reward itself after a budget that it felt went pretty well. But there was skepticism in financial markets that the real motivation for those decisions was economic as opposed to political. And I think that after the experience of high inflation in the 1970s and 1980s, that politicians came to feel that actually there was nothing to be gained by having day-to-day control of interest rates because they would simply end up being blamed for the vicissitudes of inflation. And everyone had something to gain by handing control on the day-to-day decisions on interest rates to an independent central bank.
How does the nature of the relationship then between His Majesty's government and the Bank of England operate in practice?
Well, in practice, the government will set the target for the Bank of England. There will be regular communications. I used to meet every couple of weeks with the Chancellor, and we talk about what the Bank of England was thinking about the state of the economy. And in turn, the Chancellor will be talking about his thoughts about how fiscal policy will evolve. But there was a very clear division of labour between the two. And at no stage since the Bank of England became independent in 1997, and when I left in the middle of 2013, was there any pressure from a politician of either major party to push interest rates in any direction that they wanted to see. They respected the independence of the bank.
Internally and externally, what is the role of the Governor of the Bank of England?
Well, the Governor leads the institution. He sets a strategy for the institution. He has to explain that internally and also externally. He's chair today of the three major committees that set policy in the bank: the Monetary Policy Committee, which sets interest rates and decides on quantitative easing; the Financial Policy Committee, which engages in what's called macroprudential regulation, deciding on how large are the amounts of equity which banks have to issue in general. And then the Prudential Regulation Authority is now inside the Bank of England, and that body regulates individual banks.
There are some words in there that may not be entirely familiar to everybody. What does macroprudential regulation mean, and how does it contrast with microprudential regulation?
Well, it's a good question because it's a relatively new concept. Essentially, the idea was to take a view of the financial system as a whole and try to identify various risks. That's one part of the work which the Financial Policy Committee does. But then the question is, what do you do about it if you think there are big risks? It can offer advice to the Prudential Regulation Authority about whether or not they ought to be tougher in forcing individual banks to issue more equity so they have bigger buffers to absorb losses when they see that their loans go bad. And they do have specific powers also to mandate banks to limit the scale of lending to domestic or commercial property by ensuring that they can't lend, for example, if the loan-to-value ratio, the ratio of the mortgage to the value of the property, rises above a certain level. These are new instruments. I think they're still fairly controversial, but they have been used by the Bank of England in order to try to moderate the degree of risk in the financial system as a whole. Microprudential regulation is the remit of the Prudential Regulation Authority, which sets the regulations for individual banks. And they will say, for example, to Barclays or to Lloyds, either that the amount of equity that you've issued is not high enough, or you need to take some other action in order to reduce the risks that you're taking with your balance sheet. That's to do with individual institutions. And of course, they also have to decide on whether new institutions can be admitted to be regulated banks.
And I think it's important to recognise that though your evidence today will focus on monetary policy and the decisions of the Monetary Policy Committee of the bank, there are a larger suite of measures that were undertaken by the bank during the pandemic, which perhaps fell under the umbrella of the Financial Policy Committee and the Prudential Regulation Committee.
Yes, I think certainly the Financial Policy Committee changed its view about the amount of equity capital which banks had to issue. It relaxed that so that banks would find it easier to keep lending to businesses that were under pressure and required more lending. Actions of the Prudential Regulation Authority are ones that almost by definition we as outsiders don't get to see. And there were no obvious bank failures during that period. So that is not something that I have anything to contribute on. But it's become a major part of the work of the Bank of England. If I could just illustrate with one number.
Please.
When I left the Bank of England, just before I left, before we were once again responsible for regulating banks, there were fewer than 2,000 people working at the Bank of England, primarily on monetary policy and also on the Financial Policy Committee was up and running at that point. Today, it's over 5,000 people, more than 2.5 times as large, which shows the sheer burden of work which has been created by adding the regulatory responsibilities to the bank. And of course, that adds enormously to the workload of the governor himself.
Thank you. To now move closer towards the meat of your evidence today, I'm going to ask you to explain some things about monetary policy. Firstly, could you do your best to give us a brief overview of what it is, monetary policy? What should we understand by that term?
Well, it's really all about changing the interest rate which the Bank of England sets, but I'll come back to that in a minute. The idea really is that in the economy there is a certain amount of total willingness to spend, it's called aggregate demand, and there's the value of the ability of the economy to produce potential supply, valued at the desired price level given by the inflation target. Ideally, you want these two things to be pretty equally balanced. In that situation, there's no upward pressure or downward pressure on inflation. Now, occasionally, things change. Either people become very optimistic and decide to spend more, or pessimistic and decide to spend less. And in those two situations, what the Bank of England can do is to try either to slow down the speed of spending or to accelerate it. To speed up spending, then the idea is you cut interest rates in the economy, and to speed it up and to slow it down, you raise interest rates. How does the bank do that? The bank controls one interest rate only, which is the interest rate at which it lends to or pays interest on deposits which the commercial banks hold with the Bank of England. So very large amounts of bank reserves are held by the Bank of England, but they belong to the commercial banks. We are the bank. We have the bank account for the commercial banks.
So if an individual deposits their money at a commercial bank, similarly a commercial bank will deposit its money at the Bank of England.
Correct. And if that interest rate changes, and the Bank of England announces that, which is called bank rate, if that changes, then the commercial banks know that if they wish to, if bank rate, for example, goes up, if they want to carry on lending to the private sector, then they really need to charge the private sector a bit more in order to compensate for the interest rate that they're going to be having to pay to obtain money, either from the Bank of England or indeed from other providers in the money markets in London, hedge funds and others. So bank rate does lead to a pretty much automatic pass-through to very short-term interest rates in the economy. Of course, mortgage rates and longer-term rates which are charged by banks, if a bank makes a loan for, say, 5 or 10 years, how do they decide what that rate should be? Well, they have to look not just at bank rate, but where they think bank rate will go over the next 5 or 10 years. And that is reflected in the curve in financial markets, where people out there are lending and borrowing money at 5 years or 7 years or 3 years. And you can see in those markets where people believe bank rate will go. Of course, when banks lend on mortgages or commercial property, or even more so when they're lending to business ventures, they won't want to lend just at bank rate or where they think bank rate will go. They want to add a risk premium to that to reflect the riskiness of the loan that they're making. So that matters too. But that's a factor which the commercial banks have to decide for themselves.
Could you just explain what you mean by risk premium, please?
So if for example, you said to me that you were starting a successful new business, you decided to abandon this COVID inquiry, you had a great idea for a new business, and you were going to start next week, and you didn't want money for very long, just for 3 months, I wouldn't want to be willing to lend money to you just at bank rate over the next 3 months. I'd say, well, sounds a pretty good idea. I can't be sure. There's some risk you won't be able to repay the money. So I'm going to charge you a bit more interest so that as you keep repaying it, I'm being compensated for the risk that I'm taking. And the whole spectrum of interest rates in the economy will reflect people's judgments about how safe it is to lend to various people.
And there's no point taking a risk if there's no potential reward.
Yes.
How is monetary policy, in as simple terms as is possible, different to fiscal policy?
So monetary policy operates really through both the interest rates which borrowers and lenders face in the economy, but also directly through the amount of money in the economy. And the amount of money in the economy really comprises two parts. Some part is just the amount of banknotes that exist out there that people hold. That's only about 5% of the total broad money supply. That is the money held by businesses, families, individuals, right across the economy, people who go out and spend.
So the pound coins, the £5 notes, the £50 notes, all of that together comprises only 5%
Yes.
of what you're terming broad money
Yes.
in the economy.
And the rest is primarily bank deposits. So you and I have bank deposits with our commercial bank. We can make payments out of that. It's accepted as a means of payment. That's the other 95% of money in the economy. Now, when interest rates go up or down, that leads to banks being willing to either to lend a bit less if interest rates have gone up. People don't want to borrow as much, so the amount of lending by banks to borrowers goes down.
And the reason, presumably, people don't want to borrow as much when
At a
interest
higher
rates are
rate.
high is
Yep.
because there's more risk
Yep.
to it. They have to pay more back.
And when interest rates go down, it's cheaper to borrow. If the prospect for borrowing, whether it's to buy some equipment for a business or whether it's to buy a new television set at home, it seems more attractive because the cost of paying for it has gone down. In that way, you can affect spending directly. But what also happens is that the amount of money in the economy, 95% of which is reflecting bank deposits, is affected by the amount of lending that banks do. Because most of the lending that banks do, that comprises the assets of the banking system. The loans that they have made are their claims on other people. It's their assets. When they make a loan to someone, so to a business, if I make a loan to you, then I'm going to open a bank account for you with my bank, and I'll credit you with the amount of the loan. That increases your bank account, your bank deposit. So when lending changes, bank deposits go up and down as well.
So I would take on debt, perhaps.
You would take on debt as a liability to you. To me as the bank, it's my asset. Your asset is the bank deposit, which I've created for you.
So that's the money I've gone and put in the bank, and that the bank says, we're holding this for you,
Yep.
and it's available to you when you want it.
Yep, and you can spend it whenever you want it. And that is a liability to me. It's your asset and my liability. And that affects the amount of money in the economy directly. Now, why does this matter? Easier to explain that in terms of quantitative easing, which we can come on to.
Yes.
But when you change bank rate, which has been the normal method by which central banks influence monetary policy, they do so in order to either speed up or slow down the amount of spending by the private sector.
And is it right for us to understand fiscal policy as decisions made by the government on public spending?
Yeah, so fiscal policy is decided by the central government, and it's done by direct transfers of income, essentially. I mean, the government can spend directly itself, as it would, say, through NHS or through defence or some other form of spending directly by government.
Or the furlough scheme?
Or
The furlough scheme?
Or it could be transfers of income in which it would either lower taxes or raise taxes, or say to people, in this context of the furlough scheme, we will transfer money to you, the employer, so you can reimburse your employees, even though they're not turning up to work, because we don't want to break that relationship between the employer and the employee, because we think that the break is purely temporary.
The reason I'm asking really is that your evidence today is going to focus on monetary policy.
Yep.
And so to draw a distinction in our minds between monetary policy on the one hand and fiscal policy on the other. The inquiry understands that they largely operate separately and should be thought of separately, but I think it's right to say that it's important for one to be aware of the other.
Absolutely, and that is always true, whether inside the pandemic period or outside it. So each authority, the fiscal authority, the Treasury, and the monetary authority of the Bank of England, take their own decisions using their own well-defined monetary and fiscal instruments. But in order to make their decisions, they need to take into account what the others are doing. It became, trickier during COVID because in normal times, the fiscal authority sets its budget once a year, and the Monetary Policy Committee says, okay, that's what the government's doing in fiscal policy. We will meet once a month or every 6 weeks, and we will set monetary policy in the light of the fiscal policy that's been set.
Which is relatively constant.
Yes.
In normal times.
Yeah, only changes once a year. Now, clearly
Could we
during
just
COVID, that
pause
wasn't
for
true.
1 moment, please? I can see that the screen has gone blank.
Sorry, don't worry, I just dropped something.
Thank you, my lady.
I've done it before.
I'm sorry, Lord Kinnan, I
That's all right.
interrupted you.
Where were we? And then
Good question.
we talked about the separate responsibilities, but it was vital that each authority understands what the other's doing.
And that fiscal policy during the pandemic was relatively inconstant compared to how it is usually.
Yes, exactly. Fiscal decisions were being taken, understandably, if not daily, but certainly they changed at regular intervals. That required, obviously, close cooperation. Perhaps cooperation is the wrong word, but information sharing between the Chancellor and the Treasury and the Governor and the Bank. And as far as one can tell, that worked extremely well.
The next large concept is inflation. Broadly, what is inflation and why does it matter to individuals and businesses on a daily basis?
Inflation is a rise in the price of goods and services, which we all face from day to day. Things don't all go up at the same rate, but on average, if they're going up at a rapid rate, you can tell that pretty easily. And all the evidence we have is inflation is pretty unpopular.
Love it, loathe it, or enjoy it in moderation?
No.
Why is the inflation target 2% rather than 0?
Well, there's nothing magic about figure of 2, but there are 2 good reasons for thinking of 2% as being a good target, and it's one that's been chosen by almost all industrialized countries around the world. The Office for National Statistics and statistical authorities around the world do their very best to measure the rise in prices of goods and services month by month. And they go into shops and supermarkets and measure the price. The difficulty is that quite often the quality of what you're buying improves from year to year. This is particularly true in the case of durable goods like motor cars or computers. And the ONS and others do their best to try and capture that, but they can't capture it all. And most of the studies that have taken place would suggest that at least 1%, maybe 1 to 1.5% a year of measured inflation actually corresponds to a genuine improvement in the quality of those goods and services. So a measured 2% inflation may correspond to a real inflation rate of between 0.5% and 1%. If you're going to make monetary policy work, it's quite important, and we spent much of the time in the bank doing this, to explaining to people what we were doing. The idea of explaining to people we're aiming at 1.73% inflation clearly doesn't make any sense. 2% is good enough, provided you stick to it. You can explain it and you can try to meet it. And it provides a very good benchmark by which, whenever we went to House of Commons to a select committee and were grilled on why was inflation different from your target, the benchmark was there that we had to explain why it was above or below 2%. And I think, therefore, having a very clear numerical target for inflation helps a great deal. It's that this is what we're trying to achieve. We'll never hit it exactly spot on, although in the 25 years after it was introduced, inflation pretty much was an average of 2 or 2.1%. So I think it's just the right target to hit. But of course, there is nothing especially magic about 2 rather than 1.6 or 2.4. But there is something seriously better about 2 than, say, 4, because the people who advocate allowing the inflation target to go up tend to do so only when inflation happens to be above the target. And it's convenient then to say, well, perhaps we don't worry about that, we'll let it go up.
Whatever the target is, what are the downsides to inflation being above it? Can you help us with some practical examples?
Well, I think it's quite tricky for inflation just to, suppose that the government said, well, we're going to, it's a bit of a hassle to get down to 2%, it means maybe unemployment stays a bit higher for longer. So let's just accept 4. Well, then people notice, well, okay, it's going to be 4, right? So they then start to say, well, in that case, we need a higher wage increase this year. And people selling things in shops or in businesses say...
And presumably you need a higher wage increase because the goods on the shelf cost more than they did last year.
But once you start to go up like that, where's it going to end? And people may say to themselves, if they were quite keen to go to 4 from 2, maybe at some point it could go up further. And you can quite rapidly get into a situation where inflation starts to accelerate away. That's really what happened in the 1970s, late 60s, right through the 1970s. So actually being serious about the inflation target and trying to meet it is very important, because once inflation starts to rise, then it becomes very difficult to know what is the right price or what is the right wage that I should be paid. Because you start to see that people who get a wage increase in June as opposed to November, there's quite big jumps in their relative position. And it becomes much harder for people to judge what is the right price or wage to pay for something. There is no benefit to allowing inflation to rise without limit.
What are the downsides of inflation being below target?
If inflation goes too far below target, then the risk is that what it's reflecting is that you're moving into a depression, not just a recession where output falls, but a depression where it falls substantially and stays there for a long while, the 1930s. And that can be self-fulfilling, because if prices start to fall, then businesses that have borrowed money, say they've borrowed so many pounds, thinking that they can sell their products for an appropriate price in pounds, if the value of that pound is, if inflation is negative and you start to get into negative territory, then the real burden of that debt in terms of the goods that you've got to sell becomes bigger and bigger.
So if I bought a microwave for £100, planning to sell it for 120, but now it's actually worth 90, that's a problem for me.
Yeah, and then you can't repay your debt, and you may have to sell something else. So you contract your production even further, and you get into a self-fulfilling downward spiral, and that would be, very damaging. So stability of the price level. Price stability is the phrase that central banks use all the time. Keeping inflation close to the target has enormous value.
You have explained how bank rate works. Comparing it with quantitative easing, which we will come on to next, what are the relative strengths of using bank rate to influence the economy?
Well, for a long while, bank rate has been the favoured method chosen. It's a relatively recent idea that we should always and only use bank rate. Quantitative easing is a phrase that was introduced during the financial crisis.
By which you mean?
I'll explain quantitative easing in a minute.
The financial crisis, by which you mean
crisis,
2007 to 2009.
2008-9, when the banking system in the Western world basically collapsed. The phrase it was introduced then, but essentially it's where the central bank buys government bonds. We can come back to how that works in a minute. But that was something that central banks have always done. And in the 1980s, it was called underfunding. The government was not selling as much debt to the private sector as it needed to finance its spending. The central bank was buying it instead. And so it's not something we should think of as necessarily an instrument introduced for the first time in the financial crisis in 2008-9. It had been existed before.
And the strengths of bank rate as compared with quantitative easing?
Well, quantitative easing is directly affecting the amount of money in the economy. Bank rate is directly affecting the interest rates which lenders charge either to people to borrow from them or to deposit money with them. But they have a very similar effect. What happens is both of these channels feed through to affect spending. So if interest rates go up, spending slows down. If interest rates go down, spending speeds up. And quantitative easing, the central bank buys typically from financial institutions like pension funds, hedge funds, insurance companies and others, buys government bonds. When they do that, they give that institution a check for the amount of money they're paying to buy the government bonds. Now,
Could I just pause you there one moment?
Yes.
Because I think we're now moving smoothly, if I may say so, into quantitative easing.
we are, sorry.
Government bonds is an
Yes.
important concept within quantitative easing.
Yes.
Could you unpack that first before you go on to explain the way that it operates?
So the government finances its own expenditure in two ways. One is by taxes, raising taxes directly, income tax, VAT, many other taxes, which we've learnt to hear about, if not love, in recent weeks. But it also can finance itself by borrowing. And by borrowing, it issues bonds. It sells bonds to the private sector, both in Britain and overseas. And these bonds offer the buyer an interest rate every year until the bond matures, which can be either 1 year down the road or 30 years down the road, or in some cases longer. So the government can borrow money, and it issues those bonds, and they're typically known as gilts, because when they were first issued, they were literally gilt-edged around the edge. Sadly, we can't afford now to have our bonds edged in gold. But they were gilt-edged bonds, gilts, government bonds.
Could you provide us with a brief explanation of how quantitative easing affects the real economy? And if you could you please explain some of the channels through which it operates, particularly insofar as they were relevant during the pandemic?
Yes. So quantitative easing is where the Bank of England buys government bonds from the private sector, hedge funds, pension funds, insurance companies and others. When it does that, it has to pay those institutions for the bonds which they give the Bank of England, and it does that in the form of a cheque, typically a digital cheque, which the institutions can then deposit into their bank accounts. So if a pension fund sold gilts to the Bank of England, they would be able to deposit a cheque drawn on the Bank of England into their bank account, say in Lloyds. That means their bank deposit will go up. Lloyds will then take that cheque back to the Bank of England and say, here's a cheque drawn on you, the Bank of England. I'm going to deposit into my bank account with you. So Lloyds bank reserves with the Bank of England would also go up.
So Lloyds Bank increases the amount of money in its own bank accounts, and then in the same pipeline way we discussed earlier, it deposits further money with the Bank of England, and so the Bank of England's balance sheet, its deposits go up as well.
Yes. So you've got the increase in the bank deposits of the private sector that sold the bonds to the Bank of England. That means that total bank deposits go up, broad money supply goes up. 1 for 1 with the scale of the action for quantitative easing.
And you've already explained the amount of money in the economy that is comprised of bank deposits, 95%.
Yep.
And so it's much more impactful, one might think, than simply printing money in physical form.
Yeah, though it is printing money in electronic form,
Yes.
it's adding to the deposits, the bank account deposits, 1 for 1 with a scale of QE. Now, that's how it works in practice. So what's the impact of that?
Yes.
So the institutions, pension funds, hedge funds and others that find that they've sold bonds to the Bank of England. They've got much bigger bank accounts now. They don't really want to hold a lot of extra money in their bank account. So what are they going to do? Well, they'll buy other things. They're likely to buy some more government bonds to replenish their holdings of government bonds. In turn, that's going to push up the price of those government bonds. And a rise in the price of a government bond is going to push down the effective interest rate or yield on that bond. So
just pause for one moment. The reason I think that the price will go up is because there is greater demand or
Yes.
competition for the same asset.
yes,
So we'll
There'll be-
price it at a
yeah,
higher level,
they'll be going into the market to buy government bonds.
which have now become more prized than they were before. And we don't need to go into the mechanism of this because it can be quite complicated.
Yeah, it's
But
just-
suffice to say, the assumption is if the price of a bond rises, the yield or its interest rate falls.
Yes. That means that people borrowing at longer term interest rates will find it cheaper to borrow, so they're more inclined to borrow long term to finance investment. Investment may go up, other kinds of spending may go up. But the institutions may not buy government bonds, they might buy equities. If they do that, correspondingly the price of the equity goes up, and then the yield on the equity or the cost of capital goes down. It's cheaper then for companies to issue more equity to finance investment, so they may invest more. Or the institutions might buy overseas assets, which would push down the value of sterling, make exports a little more competitive. Our export demand may go up. But in exactly the same way, that boost in the total amount of money in the economy is likely to be expansionary. And if you do the opposite, which is what the bank is doing at present,
What do you mean expansionary?
more spending. And if there's more spending, but no change in the supply in the economy, that's likely to push inflation up. Now, that may be a good thing to do if the starting point is where the amount of demand in the economy has fallen below the potential supply. Mm-hmm. So if you started in a situation where people suddenly became very pessimistic about the future and didn't want to spend, then it may make sense either to cut bank rate or to do quantitative easing in order to encourage people to spend more.
Could you briefly explain the way in which quantitative easing can impact on addressing market dysfunction? Perhaps with an example from your time as governor.
Well, I don't think in my time we ever did QE in order to deal with market dysfunction. This clearly was an issue that came up in March 2020. It may be helpful to discuss it precisely in those circumstances.
Yes.
In March 2020, some people said the government bond markets were becoming dysfunctional. I think what they meant by that was that prices were moving very rapidly by large amounts, unusually large amounts. I don't regard that as remotely surprising. In March 2020, the world learned that we were in the middle of a global pandemic. That was bound to lead to very big changes in prices of financial assets, reflecting relative profitability of different countries, different businesses, and so on. No one really knew what was the effect of COVID was going to be on individual businesses or indeed individual governments. And in that situation, excuse me, there's so much uncertainty that there's a price discovery process. How do we know what's the right price to pay for a government bond? Well, initially you're very cautious, so you try not to do too much buying and selling. You stay out of it for the moment. Activity falls. You watch what other people are willing to pay. That tells you something. And gradually, over a period of weeks, this process of toing and froing establishes a new price for government bonds, and indeed a price for many other things in the economy. Now, if that volatility is thought to be too damaging, and I'm not sure that I would have concluded that. But if you do conclude that, one way of going into that market is to say, okay, we better go in and buy these bonds ourselves to establish a floor price, give people confidence that there is a value in these bonds,
And so
and enter the market.
So somebody wondering whether to buy those government bonds would see the Bank of England buying them at price X and think the price is probably around X then.
Yes, exactly. Now, of course, the consequence of that, and that was the main justification provided for much of the QE in March 2020. But the logic of the argument is that once that dysfunction disappears, which it had done within 2 or 3 months, you would then reverse those purchases of government bonds and unwind your holdings.
I don't want to unduly cut you off. We very much will come to that aspect of your evidence. I want to first reverse slightly and set the scene for the important principles in decision making that the bank has to be aware of when there is a large scale economic shock. Presumably, it's crucial for the bank, as well as other economic actors, to accurately assess both the nature and the scale of the shock that is being faced. Could you help us with why it is important, if you agree that it is, to understand the nature and separately the scale of the shock?
I think this is the main job of the Monetary Policy Committee. The broad principles about keeping demand in line with supply are very clear. The real challenge is to work out what's happened to both demand and supply, and so that you can decide which action is appropriate to bring them back into balance. And that requires monitoring both demand and supply in the economy. Most of the data and statistics that we have relate to demand. Fewer data refer to supply. But the challenge always is to think about both demand and supply, and indeed, I would say, even more importantly, to ask the question, what is going on here? To really understand the nature of the events that have occurred since the last decision was taken on interest rates or quantitative easing. What has happened since, and what do we need to do now? And really to understand, create a narrative of what is happening in the economy.
And presumably on the basis of what you've just said, the really crucial thing to do is, whatever data you have or don't have, to conceive of it in the right way.
Yes.
To make an assessment of the data, interpret it, and calibrate a response accordingly.
Absolutely.
It's not a case, and I know we've heard other evidence in relation to science in this inquiry, it's not a case of follow the numbers. Is it more a case of make an accurate assessment on the basis of the numbers you have?
That is absolutely crucial. It's making a good judgment of what the numbers mean. And I think the way I used to describe it is every 3 months the Bank of England would produce a new report which was a narrative about what is going on in the economy, what we'd learnt since last time, have we changed our view on any element of the interpretation. But that judgment is about the nature and the scale of the difference in the balance between demand and supply.
Do you agree in principle that this shock was one that was particularly unfamiliar in both nature and scale?
Absolutely. Unprecedented.
And so with that in mind, can we examine some of the decisions taken in March 2020, June, and then November 2020? In March 2020, actions were taken in relation to monetary policy, in relation to both the bank rate and asset purchases or quantitative easing. In respect of the bank rate, on the 11th of March, the Monetary Policy Committee voted to reduce the bank rate from 0.75 to 0.25%. 0.1%. And then again, as things became somewhat clearer, on the 19th of March, they reduced it from 0.25 to 0.1%. The inquiry understands that this is termed as the effective lower bound in respect of bank rates, i.e. as close to zero as one can get. Could you explain for us why, in your view, the bank would take an approach of reducing bank rates before it considers other monetary policy interventions?
Well, of course, the change in bank rate was followed fairly quickly by a significant degree of quantitative easing.
Yes.
I suppose it was just very easy for them to decide as a committee to go down with bank rate. It may be that the bank had wanted to talk to the Treasury to reaffirm the arrangements for quantitative easing, which, there was a guarantee from the Treasury to the bank. That may have been just an operational issue. But I regard these things as essentially having been taken together in economic terms. And I think what surprised me was that the judgment of the Monetary Policy Committee at the time, as revealed in the minutes, was that they felt the impact of COVID would be a much bigger downward shock to demand than to supply. I found that puzzling at the time, and I find it even more puzzling today. And I think there's been a recognition around the world that maybe central banks jumped too quickly to the conclusion that trying to boost aggregate demand was the right response. I understand that central banks felt that in that situation, there was enormous pressure on them to do something. They were a public body. This was a major economic shock. They had to do something. The trouble is that it doesn't follow that if there is bad news, that every bit of bad news justifies a monetary policy response. There may be other things. Or in this case, it was for the government to take the appropriate actions through, for example, the furlough scheme and other schemes. And the bank did contribute with, the term funding scheme. All of these things made sense. But a general monetary policy easing, I think, was not easy to understand either at the time or subsequently.
We know, Lord King, that in March of 2020, the bank undertook £200 billion further of asset purchases, quantitative easing, QE. And that's one of the measures I think you're referring to, alongside the reductions in bank rate as being under the broad umbrella monetary easing.
Yes.
On one view, the bank viewed their asset purchases and their monetary policy interventions in March 2020 as being designed, above all else, to step in and correct market dysfunction. From your understanding of the contemporaneous material, I'd like to ask you two questions. Firstly, does that motivation stand up to scrutiny? Was it actually the motivation at the time? And secondly, was it the correct motivation?
Well, I think it's understandable that, I wouldn't have wanted to do it myself, but I think given the market dysfunction as it was perceived, and given what other central banks were doing, I think it's understandable that the Bank of England decided, well, look, let's do it. Be on the safe side and let's do it. The trouble is that it should have been unwound in the summer, because the logic behind doing it for the reasons of market dysfunction would have implied unwinding it later in the summer. There was another reason given, as I mentioned earlier in the minutes of the MPC, which was a judgment that even leaving aside the market dysfunction argument, the impact of COVID was going to have a bigger effect on demand than on supply. I think that was a misjudgment, and I certainly think that contributed to doing QE on a scale which did contribute to higher inflation further down the road. And I think it goes to the heart of what I said earlier on about trying to understand what is going on here. Forget economist jargon about demand shocks and supply shocks. What is actually happening on the ground? And of course, many of the data that came in would normally have been interpreted in terms of weak demand. You know, sales in shops down, theatre ticket sales down. But the reason they were down was not because people had become pessimistic and didn't want to spend. It's because they were banned from going to theatres or shops, or had decided for themselves that it wasn't safe to do so, or that social distancing made it a pretty unpleasant experience. So the big impact of COVID was really on the supply side. And it was the supply side measures that were taken by the government to cope with COVID-19 that generated that shock that made it impossible for people to spend. It wasn't that they were pessimistic. And what it meant was that once those restrictions were going to be released, then there was going to be pent-up demand, which would spring back, which is exactly what happened.
On one view, the public health restrictions introduced affected the way that people could behave, so limiting supply in that way. On another view, one might say that with the prospect of an infectious disease that was deadly for many, many people may have voluntarily chosen to restrict their activity.
Absolutely.
Does the argument that this was primarily a shock to supply, is it undermined by the notion of what people might voluntarily have done?
No, not at all. COVID itself was the shock, and I think it, rather than thinking about supply and demand, it may just be better, what did people do? And either because they were told that they couldn't do certain things, or because they made their own decisions about what to do, that meant that made it impossible for people chose. You know, we were not going to contribute to production activity in the economy. We're not going to go to work. And this was not a reduction in spending that resulted from people's unwillingness to spend because they were pessimistic. It resulted from the nature of COVID itself. Once that had gone away, then there was no reason to suppose that their willingness to spend wouldn't just snap back again.
But judging the bank's actions in foresight rather than hindsight, was any of that knowable in March 2020?
I think it was. I mean, I think the number of people commented about the fact that, you know, what the bank had done was to lead to a very significant increase in the broad money supply. They weren't alone in doing this. I mean, the Federal Reserve were absolutely in the same boat. So I don't think this is something where I would put blame at the door of the Bank of England. I think in many ways it's blame at the door of the academic community, which wanted to use traditional models to think about this. But the fact is, the reason why spending fell, the reason why, retailers couldn't sell, restaurants couldn't sell their meals, was because of the nature of COVID, not because there was some lack of general willingness to spend, for which monetary policy expansion would be the appropriate response. If you start off with a balance between demand and supply goes down, the last thing you want to do is to boost demand. That's going to give you inflation. And COVID, in many ways, was almost a textbook example of too much money chasing too few goods. COVID reduced the number of goods. The bank could increase the amount of money.
And so I think I understand from that your view, and perhaps it's a widely accepted view, is that in undertaking monetary easing, particularly in the form of additional quantitative easing, there was a risk at some point that there would be significantly higher inflation than was desirable.
That was a view that a minority of economists had. I was in that minority. I think there was, in the United States, which tends to have a disproportionate influence on economic debate, there was a group of people who became known as team transitory. Any rise in inflation through COVID affecting supply chains and so on would be transitory, and that meant there was no need to raise interest rates, inflation would go away of its own accord. I didn't accept that, and there are very distinguished economists in the States who didn't accept it. But nevertheless, it was, I would say, a majority view in the academic profession, and I think it's quite hard to blame central banks for not standing out from that. You know, they were influenced by it. But I think with the benefit of hindsight, many people would now say, well, Team Transitory got it wrong. We had to raise interest rates from close to zero to around 5%. And even 5 years on, inflation's still above target. So the idea that it went away of its own accord simply wasn't true.
On the point of perhaps balancing risks in monetary policy decisions, particularly acute risks at a time of high uncertainty and high economic turmoil, could I ask you to have a look at and then comment on the view of James Smith, who has produced an expert report for the inquiry in this module? It's INQ 000588133. It's paragraph 29 on page 11.
So I see the paragraph in front of me.
Yes, I'm afraid this isn't the one
That's paragraph 29.
Yes, this is the one that's on the page.
Yep.
This paragraph, for context for you, comes after a graph that James Smith produced, a graph of VIX, which I think is a graph that maybe in crude terms demonstrates, as you can see on the screen there, market volatility. I don't necessarily want to go into the technical details of this graph, but I'd like to put to you the narrative of paragraph 29, please.
Yes.
And it's this. As shown in figure 4, which is the figure we've just looked at, measures of financial market volatility reached very extreme levels, even higher than during the financial crisis of 2008, indicating large falls in asset prices. But after the first few months of the pandemic, there was a significant easing in financial conditions. It is striking that, during this period, the huge economic hit and the big swings in asset prices did not lead to the collapse of financial institutions or financial infrastructure. As discussed below, this was by no means assured before the crisis, with the Bank of England repeatedly warning about the risks in the financial system and low levels of liquidity since the financial crisis. And the question I want to ask really is, was the risk in not undertaking quantitative easing far too great to contemplate, regardless of the risk of inflation?
No, I don't think that at all. I think that if one was concerned about low levels of liquidity, it would have been better to have introduced, as has happened before, a scheme to provide liquidity to those institutions that were at risk, and then to withdraw that liquidity when conditions return more to normal. The problem with doing quantitative easing is that it did a lot more than that. It actually boosted aggregate money supply, and that did create a bigger risk of inflation. So there were alternatives to dealing with it. But I think this paragraph demonstrates why I said it's so important to think about what is going on here. In the financial crisis, 2008-9, it's true that the volatility in asset prices was less in some periods than it was in March 2020. But the risk to financial institutions, banks in particular, was much greater in 2008 than it was in 2020. By 2020, banks were better capitalized. They actually had quite a lot of liquidity in the form of these bank deposits with the Bank of England. They weren't facing the risks that we saw in 2008. So rather than thinking about these abstract concepts, like sort of financial risks or demand or supply, I think it is very important, and this is what central banks really have to do, is to get to grips with what is actually happening in the economy. If there were concerns about a range of financial institutions in March 2020, then actually lending directly to them through a liquidity scheme would have been would have directed support where it was needed. But as this paragraph says, after the first few months of the pandemic, there was a significant easing in financial conditions. So the need for support was reduced at that point, but the support itself was not withdrawn.
And so we'll move to that in just one moment. I just want to end our discussion of March 2020 with trying to understand how high you pitch the criticism, effectively, of the actions taken, not just by the bank, but by central banks around the developed world. Is it fair to characterise your view as being somewhat critical of the actions of the bank in March 2020, but had those actions been unwound quickly thereafter, there wouldn't be as much space between your argument and the argument of others?
Yeah, and I think if they had been unwound, say in the summer, then I would have no criticism. I think it's a fairly, I think you can argue either way, whether it was sensible to do QE in March 2020, but if it had been withdrawn, it would have been withdrawn for the right reasons, and then I would have had no criticism.
And presumably there's always a range of reasonable interpretations,
yes,
reasonable responses, and it's for the committee of the day to make those decisions.
Yeah, and I wasn't present. I don't know how concerned I would have been, but I don't think if I had been concerned about financial disruption, I would have unwound it in the summer. Where I would have disagreed is the view, excuse me, that COVID was having a bigger effect on demand than on supply.
I'm going to ask you next about June 2020 and then about November 2020. In June 2020, the bank undertook a further extension of quantitative easing of £100 billion. Of course, the bank rate at this stage was already at 0.1%, so there was little to be done in that regard. Before I ask you to give your view of whether or not that was the appropriate action to take, could you help us with your understanding of why the bank undertook that extra quantitative easing at the time?
I think we'll have to ask them to explain why they decided to add to it then. I suppose my concern about a lot of this is that whenever events changed and there seemed to be a problem, the bank felt it had to step in and do something. And all it could do, really, in general terms, was yet more quantitative easing. And as I said, I think it is very important. I think many central banks, since the financial crisis, have fallen into the trap of accepting the description of being the only game in town. And I think what COVID revealed was they're not the only game in town. The government is another, even more important game in town.
And this chimes, I think, with the recognition that monetary policy and fiscal policy need to be aware of each other.
Yes, exactly. So when there are challenges that come up, and it was a very difficult set of circumstances, there's no question about it. It just takes enormous willpower to say, I know there are problems. I know that you feel something should be done. Actually, monetary policy is not the right thing to do because it will threaten inflation down the road. We have to find a different way of dealing with it. That requires a great deal of strength and there are enormous pressures on the governor in particular to say, you've got to do something. And I think it's important to be able to resist that.
And so in June 2020, we've tried to work out exactly how strong your view was in relation to March 2020 and you've explained that if it were unwound in the summer, you wouldn't have a particularly strong view.
Yeah.
But I think your view does strengthen.
Yes, it does, from the June onwards, yes.
Why does it strengthen?
Because it was creating a risk to inflation.
The risk to inflation was present in March 2020, but I think the balance was perhaps finer in your mind then.
Well, I think that if you undo the boost to the money supply in March by withdrawing that increase in money supply in June, you're unlikely to have caused any long-run impact on inflation.
What were the benefits of undertaking further quantitative easing in June 2020?
Well, I think it reflects the view, as shown in the minutes, that people on the committee felt that they were more worried about the downside risk to demand than they were. They interpreted events as saying, this is a big fall in demand, bigger than supply. And I'm puzzled by that. And I think that it was always clear that once you remove the restrictions, and once there was a vaccine, and once COVID started to become less of a problem, that we would return to where we had been. And if people had been unable to spend for a period, then actually there'd be pent-up spending power, which would then come out, which would require monetary policy to respond to that. So I think going into a period where you felt we're gradually moving towards a period where COVID will be less of a problem, it was strange to keep interest rates at rock bottom and yet to do more quantitative easing.
I think your view is that with more broad money in the economy, inflation is very likely. Is it your view that it's inevitable or not?
No, I don't think it's inevitable, and I don't think there's a mechanical link between a change in broad money and inflation. But when you see the amount of broad money in the economy rising by record rates, and it was rising, well into double-digit rates by the end of 2020, peaking at 15% in early 2021, you ought to be asking yourself the question, what is going on here? Why can I afford to ignore that? Now, there may be reasons, and no doubt in the 1980s, there were good reasons at various times to say these broad money figures are giving us a distorted picture of the underlying degree of inflationary pressure, perhaps because of changes in financial structure or regulation. That didn't seem any obvious explanation like that. But what the bank should have done at that point was certainly to have drawn attention to it and said, well, we note that it's growing very rapidly, but for the following reasons, we've decided to ignore it. That wasn't done. And I think this goes back to the question of how you calibrate the amount of quantitative easing. To my mind, the easiest step in calibrating it is to say, if we do quantitative easing of, say, 100 billion, then this is equivalent to an X% increase in broad money supply. Can we justify that in terms of what's going on in the economy? And maybe you can, maybe you can't, but it's a way of calibrating it. It was very difficult for people outside all central banks, not just the Bank of England. And my critique here is not of the Bank of England as such, it's of all central banks in the industrialized world, that they just ignored what was happening to broad money and didn't make any attempt to say, well, we take note of it, we're not going to respond to it for the following reason. I think you have to have an explanation as to why you're not going to respond to it when the increases are so large.
Thank you. My lady, I don't know if now would be an appropriate moment to have the mid-morning break.
Certainly, I suspect Lord King needs to have some glass of water or two. I hope your voice survives, Lord King.
Thank you.
We know that you have other commitments, so the team will make sure you get away when you have to.
Thank you.
Thank you very much. I shall break now until I'll break for 15 minutes, so come back at, let's see what the time is. 25
past.
5 past, yeah. Thank you.
Thank you. My lady, can you see us and can you hear us?
I can, thank you, Mr. Hudson.
Lord King, before we get back to the questioning, just one matter of correction. I don't need it to be brought up, but you have alerted the inquiry to a typographical error in your witness statement. Your witness statement is INQ 000656310. Page 3, paragraph 5, you wrote this. Doctors and politicians share one problem in common. Patients and voters want to believe that their voters and political leaders know what they're doing, and you meant doctors and political leaders.
Indeed.
Returning to the substance of the questions then, and November 2020, and the decision by the Bank of England to engage in a further £150 billion of quantitative easing. We've effectively rated your view as not so strong on March, relatively strong on June. Is your view very strong that the November extension was the wrong thing to do?
I think the same as in June, that I wouldn't have, I'm not persuaded by the arguments that were given for it. It's almost as if there was a view that there had to be some further monetary support of the economy if we were to come out of COVID and see economic growth again. And as I've explained, I think that the real issues, which were real and serious, were much more on the supply side, which were government issues, rather than on the side of the bank. And I understand the pressures that would have been brought to bear on the bank. You know, you must do something to help us, you must do something. But there are times when you have to say, well, there's no intellectual case for doing something on monetary policy. We will support you in other areas. And the bank did a lot of work in other areas, different schemes to lend to businesses for short periods, for longer periods, to boost liquidity. All of these things were sensible. But it was the broad question of keeping interest rates very low for so long and doing quantitative easing, not unwinding the March, but doing more in June and November. These things, I think, reflected what I would describe as an unfortunate judgment that the impact on demand as such was much greater than the impact on supply. And I understand why that came about. I think it was a judgment. I mean, central banks speak to each other. Everyone would have been in the same position. What can we do to help? And it's very hard to stand out against that.
Just one point of clarification. When you referred to pressure there, I think it's plain to those of us in the hearing room, but you didn't mean any improper pressure or political interference?
No, certainly not
Intellectual
improper.
pressure.
No, I just think that, and not from senior politicians, I think even from within the bank or from officials in the Treasury, there would have been this view, we've just got to do everything we can. But there's no point doing everything we can if one of the things that you do has an adverse consequence of higher inflation, but doesn't actually help with any of the issues that you're facing. You do require very clear intellectual analysis of why you're doing what you're doing. And I think that was, it wasn't as clear as it should have been. And I've explained why in terms of the failure to take into account the growth of broad money. But why on earth there was in general a wish to boost aggregate demand to deal with this situation. If I can refer, in my evidence, I refer to a comment which Professor Summers made in the United States, the former Treasury Secretary. He had pointed out long before that the Biden fiscal injections were way over the top in terms of what was needed, given any apparent disparity between aggregate demand and aggregate supply, the so-called output gap, where aggregate demand falls below aggregate supply.
Which would require a boost to demand
boost
to
to
bring
demand.
the two closer together.
As he pointed out, this isn't rocket science. This is sort of very basic stuff. But I think in the wish to be willing to do something, politicians and others got swept up in the idea that whatever you can think of doing, we just do. And that's a mistake. You've got to think very carefully about what it is you're doing and why.
This is a very engaging intellectual difference of view and a difference of judgments that may have been made at the time. The inquiry is interested in getting to the bottom of what it can realistically look at as lessons to be learned for the future, the concrete steps of how could this be done better in future circumstances. I will come on to discuss data at a later point, but I think your main point is that this is a problem of assessment of the existing data rather than having simply more data.
Yes.
Could you help us at all with concrete steps that could be taken to improve this situation, in your view?
Well, I think one very concrete one is that when central banks engage in quantitative easing, they provide an explanation in terms of the calibration of it. Why 100 billion, not 200 billion? How do they think about it? And I think one of the problems that central banks have had ever since the financial crisis is the inability to think about quantitative easing in terms of its initial impact on the amount of broad money in the economy. One can certainly debate how, in particular circumstances, a given increase in the amount of money in the economy will affect the economy. That's a matter for assessment and debate. Plenty of room for different opinions. But it's a way of calibrating, why would you want to increase broad money by 7% or 15%? Some numbers that will help to provide an explanation. Nothing was really provided. And I think that is one thing I would suggest. More to the point generally, I think there has been, and again, many central banks would deny this, but I do think in the House of Lords report recently on the Bank of England talked about this, that it's easy to fall into groupthink in central banks. You speak to each other, you recruit the same kinds of people from the same kinds of graduate schools. They have the same way of thinking about things. And it's quite important on policy-making committees to have at least one or two people who think about it in a different way from a different background. And it's too easy in the world of economics for people to assume that a certain way of thinking about things makes sense. I've always been impressed that in jury trials in court, no one is allowed to say, oh God, it's him again, turning up. You stick to a narrative about what's happened in this particular case, what's going on here. And central banks are not so good at saying what is going on here. They like to put it into compartments. Well, this is a demand shock, or this is a supply shock. That's how we respond to it. There needs to be much better focus on what's going on here. And to do that, you need people whose natural instinct is to say, what actually happened? What's happening to this business or that business? One of the most useful people on the Monetary Policy Committee in my time was a non-economist who was prepared to ask the kind of questions that no economist was willing to ask because they didn't want to be shown up as not knowing the answer to it. And having that diverse range of opinions, I think, is very important. It doesn't determine the outcome, but you need to have something which is not just the output of the standard economic view.
Thank you, Lord King. There are two final topics, if we have time. The first is to look at the inflation that came in 2021. And there is a table I'd like to draw your attention to, which has been provided to the inquiry by the United Kingdom Statistics Authority, or the ONS. The reference number is INQ 000657600, and there is a table at page, 106, which deals with CPI and PPI, and I'll ask you to unpack these concepts briefly if we can. But in essence, what this table shows is a reference period of March 2021 to January 2022. The publication of the statistics comes roughly a month after the period they relate to. We have chosen this period because the first uptick that can be seen inflation in this period, at least in respect of the Consumer Prices Index, is around April 2021, and we've ended on February the 16th, 2022, because we know in February 2022 Russia invaded Ukraine, and causation, if I can put it that way, becomes a little muddier. Firstly, the Consumer Prices Index, that's the measure of inflation to which the bank's price stability objective of 2% is tied, isn't it?
Correct, yes.
PPI is the Producer Price Index. Could you, as briefly as you can, explain what that is and how it relates to the CPI?
Well, this is referring only to those goods and services directly produced by businesses where they really transact with each other. So, there can be input prices and output prices. If you're making steel or cardboard boxes or packaging, it will show up in the PPI. CPI is about the things that you and I buy, goods and services that households buy.
We can see that PPI seems to uptick more quickly earlier in time than CPI. Does that mean that PPI is an earlier indicator than CPI of where inflation might be in the future?
Yes, it is typically a leading indicator of where CPI will go.
Is it as reliable as a statistic as CPI?
CPI is an index of the thing we want to control, which is the inflation that households face. PPI is about what's going on in the business world. And sometimes that may go up quite sharply and then come down quite sharply, and may not be, therefore, a good indicator. CPI may not change very much in that respect. But it's certainly something that we always looked at as a potential leading indicator of underlying inflationary trends, yes.
The broad topic area here is concerned with actions taken or not taken by the Bank of England in this reference period, so effectively April 21 to January 22, in its decisions not until December 2021 to raise the bank rate in view of signals that we may be seeing increased rates of inflation. Are you critical of the bank's approach in 2021 in reacting to inflationary indicators or not?
Well, I think most central banks today would recognise that they were very slow to raise interest rates. They got into a habit of changing interest rates by maybe 0.25%, 25 basis points in the jargon each time, rather than doing more. My own feeling is it would have been better to have recognised at some point in the first half of 2021 that it had been a mistake to stoke up demand too much, and therefore you had to unwind a lot of that. That would have been a much sharper rise in interest rates. It's quite striking that bank rate didn't rise above its pre-COVID level until well into 2022. As you say, they did start to raise rates in December 21, but only by a small amount, and it was still then below where it had been before COVID hit. So it was a very slow response. The bank did then keep raising rates, yes, and they kept at it. So during 22, they certainly were catching up. I think most central banks would probably say they could have caught up faster, but at least they were going in the right direction.
A point on the causes of inflation that we saw in April 2021 through to October 2022. October 22 is, of course, outside our reference period, but one might look to things that happened within our reference period to see whether they had an impact beyond it. We had a global pandemic which had effects of its own.
Yep.
The bank responded to the pandemic, and in February 22 there was another huge economic shock globally. To what extent would you lay at the door of the decisions of the bank increased interest rates that were alarming in 2022?
Sorry, is it the lay at the door of the bank, the
decisions taken by the bank during the pandemic
Yep.
in respect to monetary easing, quantitative easing
Yep.
in particular?
Yep.
Do you think they caused the inflation that we saw thereafter? And if so, to what extent?
Well, they contributed significantly to it, but not entirely. And there's no doubt that the events in February 2022 and maybe some other effects surrounding COVID did contribute directly to higher inflation, yes. But nevertheless, it wouldn't have gone up into double-digit figures, I think, had it not been for the monetary expansion which the bank engaged in 2020.
Final topic then, and that's data looking towards the future. I wonder if I could have your statement at paragraph 21 on the screen, please. The I&Q reference number. I will have in a moment. Thank you. It's I&Q 000656. I think it was 0310. Here, you effectively make a recommendation for the data landscape in the United Kingdom. I'd like to read this out and then ask for your for some further reflections on this. You say the bank made effective use of the available data on the effects of the pandemic on the economy. But the pandemic made the task for the Office for National Statistics more difficult. How, for example, can one measure the cost of a theatre ticket when all theatres are shut? My recommendation would be to set up some machinery so that in the event of a similar crisis, a small special unit would quickly bring together experts from Treasury, Bank, ONS and other relevant departments to talk through how to find alternatives to data that had become unreliable. To think of data that would be helpful in tackling the crisis, such as national survey, to discover how many people were suffering from the crisis, from the virus, to calculate the implied mortality rate, and to suggest how administrative data could be used to complement the usual sources of ONS statistics. Is this a body that you see being stood up now that can operate in the background in terms of preparedness, or is this a crisis response body?
It's a crisis response body. I think my experience of different crises at the bank was that the kind of people you need to run an organisation in normal times are not necessarily the best ones equipped to lead it in crisis times. And I think here, you've got all of these institutions inevitably are bureaucratic. That has very many benefits because things are done in the right way, but it makes them pretty slow to deal with something unexpected. And I think here, the theatre ticket example I gave, the ONS, realised that certain things could not be bought and sold. So they tried to think about ways in which you could impute a price that wouldn't necessarily distort the resulting inflation measure. But it's very difficult to know how to do that. You could argue, for example, that if you're not allowed into a theatre, the price is almost infinite. How do you incorporate that in a price index? I think what it needs in a crisis where these questions arise that you don't normally face. It's not just collecting data in the normal standard way. You need a group of bright young people to come together in a small unit and say, look, here are some big questions. What's the best way of tackling them? And then to feed that back so that the bureaucratic organizations can respond and collect new data that they themselves are not really inspired to think of collecting, what data to collect, how to impute prices when various things can't be bought and sold. There are many aspects of data that were affected by COVID where you need to take a completely fresh look. And I think a small special unit bringing people from the different departments together, especially bright young people, to talk through some of these issues and to make judgments about what to do in the crisis would be very valuable.
Well, King, thank you. That's the end of the questions I wanted to ask you. You've provided a helpful recommendation there at the end on data. Before we finish your evidence session today, are there any concluding thoughts that you wanted to leave the inquiry with?
No, I don't think so. I think all my thoughts are in the evidence. I think that, as I said in the conclusion of my written evidence, we are blessed with having outstanding public servants who are deeply committed to doing the right thing and did their very best. And any critique that I've made in my evidence is not of the individuals or the institutions for which they work. It's, in a sense, for the academic community in economics and the wider group of economists working in public policy that basically, I think, made central banks walk a little bit into a blind alley and ignore the role of money in inflation. That's not the fault of individual central banks or individuals within it. But it is a plea for having more diverse thinking in central banks.
Lord King, thank you.
Thank you.
Lord King, that completes the questions we have for you. You mentioned the bright young people and outstanding civil servants. I can also attest to the value of both those. And thank you very much for all the help that you've given to the inquiry. I understand you've been extraordinarily helpful and cooperative, and I'm really grateful to you. I just hope you're not going on another speaking engagement now.
I fear I have a Zoom call, but I'll try and say as little as possible.
Well, as somebody who's had to cope with public speaking with a bad, having suffered some kind of bug and then got a voice going, I hope you survive. Anyway, thank you very much indeed for all your help. And obviously we'll bear very much in mind what's in your written statement as well. Thank you.
Thank you. And every best wish for the inquiry. Thank you. It's very important.
Thank you very much. Mr. Wright.
My lady, the next witness is Andrew Bailey.
Would you like to take the Bible and just repeat after me? I swear by Almighty God.
I swear by Almighty God that the evidence I shall give shall be the truth, the whole truth, and nothing but the truth.
Thank you. Please sit down.
Thank you for joining us, Mr. Bailey. I hope we haven't kept you waiting too long.
Not at all.
Mr. Bailey, you are the Governor of the Bank of England and you have provided a statement to the inquiry, and I'll just read the statement reference into the record, which is INQ 000-6575113. Mr. Bailey, I say you're the Governor of the Bank of England. You became Governor, as the inquiry understands it, on the 16th of March 2020, is that right?
That's correct, yes.
But that wasn't the date that you started work at the bank. You had a long history working at the bank before that, and had previously worked with the Governor, your predecessor, Mark Carney, is that right?
And indeed Lord King, his predecessor, and his predecessor, Lord
Yes.
George, as well, so yes.
Yeah. Wouldn't want there to be the impression you just walked in on the 16th of March.
No, I had been out of the bank for a few years as Chief Executive of the FCA.
Yes. Now, we just, if we can, need to deal with a few background issues. The Bank of England is an independent central bank, and we'll look at what independence means and how it in practice operates. But is it right that the mission of the bank is to promote the good of the people of the United Kingdom by maintaining monetary and financial stability?
That's correct, yes.
And the corporate statement that the bank has provided says this about causes of any disturbance that may affect monetary or financial stability, that the bank is agnostic as to the cause of any such disturbance. So could you just explain what you mean by that?
Well, in the first instance, it means that, of course, we take no position on the rights and wrongs of those causes. We deal with the causes as we see them. So I think agnosticism should be viewed in that light. We deal with the evidence as it is presented to us, as it were, or presents itself to us.
Yeah. And you make a reaction to that evidence.
Indeed.
acting in those overall interests of the country.
Yes.
And during the pandemic period, should we think about the central decision-making bodies in the bank, other than yourself as governor, as being the Monetary Policy Committee, the Financial Policy Committee, and the Prudential Regulation Committee?
Well, those are the policy committees. The bank has, as an institution, has responsibilities which are particularly focused on, obviously, then conducting and implementing the policies that are decided upon, and those responsibilities fall to the executive of the bank, which I'm the head of.
Yeah. Just want to pick up monetary policy as a concept.
Yes.
And what it is and how it's different to fiscal policy. Can you just explain that in simple terms?
Well, monetary policy has as its objective what's called price stability. And that is defined in the UK by statute as being an inflation target, and it's defined as 2% annually. So the objective of the Bank of England in respect of monetary policy is to achieve price stability by achieving that inflation objective. Fiscal policy is completely separate to the Bank of England. That's the responsibility of the government and has a whole, obviously, series of objectives which go much wider than that. So monetary policy, by comparison, is actually very narrowly focused.
Yeah. And so fiscal policy, we should think about how the government spends money, how it generates money, how it spends money. The bank's focused on monetary policy.
Yeah, well, not for me to speak, but I mean, the government has obviously objectives with fiscal policy. It's not just about, raising and spending money. I mean, that's a means to an end, if you like, but I think it's obviously more important for the government to set that out than for the Bank of England.
Yeah, okay. And the Monetary Policy Committee, as a committee of the bank, is independent of the Treasury, is that right?
That's right, yes.
And it takes its decisions as a committee by vote?
Yes.
And as you've said, it has that statutory objective because it's prescribed in statute in
Yes.
the Bank of England Act 1998 to achieve price stability with a target of 2% inflation.
Yes, I mean, I think it's important just to interpret that the bank is not, in this respect, in respect of monetary policy, of course, independent of Parliament in that sense. Parliament has passed the legislation, so it's Parliament that has determined the framework. The government sets the objective, that is the 2% inflation target annually. The Chancellor writes to the Governor annually. So independence is a very carefully crafted concept in that respect.
And the Chancellor could change the target.
Yes.
That's the point.
Yes.
Not the bank independently setting its
by the way,
own
the UK system is a little bit different to many other countries in this respect. That in many other countries, there isn't that formal target setting role for the government. In many other systems, the objective is set by some form of usually statute or legislative body, and it's left to the central bank as to how they put it into effect. So the UK is a rather more formalised system in that sense.
Yeah. So that's one statutory objective, price stability. Subject to that, the bank is also required to support the economic policy of government relating to employment
Yes.
and growth. Is that right?
That's right, and it's important. The language you've used is exactly correct, and it's very important to be precise on this, as you were, because it's what I call a hierarchical objective. So the critical language that you just said was the subject to that.
Yes. And that's what I was going to come on to. No, don't worry, and give you an opportunity to explain, really. They need to be looked at in a hierarchical way.
Yes.
And if you could just pick up on that, how those two things, therefore, sit one with the other.
So what it means is that the primary and the overarching objective is the price stability objective. So it's the first objective, the inflation objective. And then the subject to that is interpreted primarily via a remit letter that the Chancellor sends to the Governor every year, which, again, in the language of the Act, tells the Bank and the Monetary Policy Committee what the policies of the government are, and therefore how we can interpret them in respect of the secondary objective.
Thank you. We've heard from Lord King this morning, who has given some explanation from his perspective about inflation as a concept. And he has explained that there are different measures of inflation, different indices that measure inflation. And we've picked up on the producer price index, the PPI, and the consumer price index. So there are different ways of measuring inflation, but from the perspective of the public, thinking about what it's going to cost the public to buy goods, is that the CPI is really the
Well, it's important that
the index.
Yes. So the remit, again, which the Chancellor writes to the Governor every year, is set in terms of CPI. And indeed, over the history of the Monetary Policy Committee, going back, as you just mentioned, to the legislation and its origin in 1997, there has only been one change. Although, as you said, the government can change it every year. There's only been one change when the index was changed from the RPIX, the retail price index, which is one was used in the early days, to the CPI, which is the consumer price index, which is the one that's been used for quite a long time now.
Yeah, okay. And again, this was touched on by Lord King, but I'll give you an opportunity to speak to it. You don't set the target, but generally speaking, 2% has been the target for some time. And Lord King's evidence was that is, generally speaking, about the target of most central banks that have inflationary targets. Just briefly pick up on why, the way he put it is there's no magic in 2 as opposed to 1.8 or 2.2, but about 2%. Why?
Yes, well, I agree with him on that. There is no magic to this. The starting point, as I mentioned a few minutes ago, is price stability. Which of course is words, not numbers. So then the question is, well, how do you what is the meaning of price stability? So I think the best interpretation I can give you is one actually that I think originated with Alan Greenspan, the former chair of the United States Federal Reserve, when he described price stability as a state where members of the public, firms, consumers and businesses do not explicitly factor inflation, what they think inflation is and is going to be, into their everyday decisions on whether they buy something today or don't, or invest as a firm today or wait. They're, if you like to go back to your original word, agnostic on that front. And I think that's a useful definition, but of course it's open to the challenge that it doesn't tell you what the number is. So the number, then, I think you have to get from saying, well, okay, that's a nice concept, turn that into a number. And I agree with Lord King. Not all central banks, by the way, have a numerical target, but for those that do and those that talk about it, 2 is a number that is considered to be consistent with that principle that I just laid out, that Alan Greenspan came up with. And you can ask, well, why isn't it 0? And my answer to that would be that you need some positive level because relative prices do change. I mean, that's, the price of this versus the price of that can change, from time to time. And the risk of 0 is that, frankly, we can't control inflation down to the last endpoint. And if it goes below 0 and you get the risk of deflation, deflation is actually in many ways worse than inflation as a risk because, going back to my point about whether people's decision-making is influenced. If you think prices are going to go down over time, then you will delay buying things, and that will actually cause the demand in the economy to shrink further. So it's wise to have it a bit above 0, and therefore you end up with 2.
Okay. So that if there is any magic, that's it.
That's it. Yes.
Yes. All right. So can we just look at the tools that you have available as governor, as the bank, the tools you have to affect the rate or try and affect the rate of inflation? Is one of those tools, one of those levers, that the bank rate?
Well, it's the main tool, yes. Yeah. So the setting of what we call the official interest rate is the main tool.
Yeah. And how does that work?
Well, it works in the sense that it is the rate that the Bank of England pays on so-called reserves held by the banks in accounts at the Bank of England, which is, if you like, the sort of highest quality form of money in the economy. So that's the rate that we pay to banks. And there's, if you like, you can think about it as a sort of ripple effect outwards, that because we set that rate, that then sort of ripples outwards in terms of the rates that banks charge and pay. So it affects the rates they pay on the savings that we hold at banks, and it affects the rates that we pay when we borrow from banks. So if we have a mortgage or if we're a company. And that's therefore the mechanism that we use, that we sort of set the rate that's sort of anchored, which is the official rate that we pay on reserves, expecting it then to sort of ripple out through the economy. And we therefore spend a lot of time looking at what we call the monetary transmission mechanism, which is, if you like, that ripple effect.
Yeah. So
How's it working?
If you put up the bank rate, commercial lenders put up their rates.
Yeah.
Therefore, if I've got money, it becomes more attractive for me to save it because I'll get a higher rate of return, to lodge it with a commercial bank. Equally, if I want to borrow money to spend, it's going to make it more expensive for me to do that.
That's right. But if you don't mind me saying, so this mechanism changes over time. So let me give you the best example of this over the last sort of 20 years in this country, that if you go back 20 years, we all had mortgages that were what we call variable rate. What that meant was that if the Bank of England changed the bank rate, the next day, you may remember there were always notices in newspapers saying, I'm X bank and my bank, my mortgage rate has changed by usually the same amount that we changed it by. Well, that's not true anymore. I mean, most people have mortgages that are set for 2 years, 5 years, 7 years, and so that ripple effect. This is why we have to spend so much time looking at it. It does change over time because, in other words, the effect of us changing rates has now been modulated through for instance, a mortgage system that actually takes longer to actually transmit.
Yeah. So looking at that and picking that up, this isn't a lever that you can pull and necessarily expect to see immediate change. Is that right?
Oh, that's right. I mean, it's a lever that we obviously do pull it, but it's a lever where we have to study very carefully the length of time that the reactions take.
It's a bit like turning a super tanker. You put the helm over. And it takes time for it to start to come around.
Yes, you can actually. You can think of it in those terms. Yes.
Yeah. Okay. And another lever, if you like, that we've discussed this morning with Lord King, is quantitative easing.
Yes.
And/or tightening.
Yes.
Can you just explain that as a concept?
Well, first of all, I mean, I think all central banks are in this position. Our strong order of ranking is that the official interest rate, bank rate, is our tool of preference. So in all circumstances when it's open to us, we will use bank rate as the tool of monetary policy. We think it's most efficient and most effective. Now, the problem becomes, what do you do when it gets near to zero? What we tend to call the lower bound.
And can I just come in there I hope to make a point of context. When we were coming into the pandemic, when the country was coming into the pandemic,
yes, the
rate was historically very low,
yes,
and very close to zero.
Yes. So the history of this is that really as a cause of the global financial crisis, which happened sort of 2007, 8. A little bit into 2009, during Lord King's time, the MPC had to cut the bank rate down to nearly zero. So it was around about 0.75%, 0.75% eventually, when it got down to that low. And therefore, and it persisted there for the whole of the period between the global financial crisis and the onset of COVID.
Can I just pause you there, Mr. Bailey? I'm being asked, and I'm sorry, I've had to ask most witnesses, can you just slow down a little bit?
Of course, yes.
It's only because the stenographer needs to keep up.
I apologise, yes.
Their fingers are starting to smoke as they're typing.
Okay.
So if we can just slow it down a little bit.
Fine, yes.
Thank you. Let's start again. You were talking about the financial crisis. Yes. Bank rate had come down. It was about...
Yes, so for the whole of the period from really sort of the beginning of 2009 through to 2020, so the onset of COVID, the bank rate had been at what was considered pretty much the lower bound, which was just above zero. So to go back to your question of the role of quantitative easing, the question then arises, what are the tools that could be used in the event that if bank rate is considered to be at its lower bound, and we may come on to this later, there is a debate as to whether the lower bound really is the lower bound. what do you do next if you find yourself in a position where inflation is going to miss the target on the downside, that's the 2% target, but you don't believe that you can cut bank rate anymore in response to that. And that's where quantitative easing comes in. Now, quantitative easing, in the simplest terms, I think, it's a fiendishly complicated area, I have to be honest. The simplest, I think, description I can give is that it involves the central bank buying longer term assets. So if you like, taking them out of circulation and putting money in instead. Central banks can create money in that sense. And so you put in something that is liquid in return for something that is less liquid. And that liquidity goes onto the, as I said, the reserve accounts of the banks. So we buy the assets and the liquidity goes onto the reserve accounts that the banks hold at the Bank of England and is then available for lending to support the economy. So that's I think in the simplest terms I can sort of give you, that's the sort of simple version of it. It's not, nobody I think I would know of would ever describe it as a tool that is as effective as the interest rate tool. We're in the world of second best here at most.
Right. So it's a secondary lever and almost an emergency lever that you can use if the bank rate is at lower bound and therefore there's not much room to manoeuvre.
That's right. Now, I mentioned a minute or two ago, I should say that there is a debate, and indeed you may be aware that the Bank of England, we had a debate during the COVID period, which goes back to this question about is the lower bound of interest rates really a lower bound?
Now, we'll come on to this, but let's pick it up here because I'm quite happy to have a dialogue. So this is the idea, that you can move below zero into negative rates?
Yes, so some central banks have used negative interest rates and therefore, in a sense, concluded that the lower bound isn't the lower bound. And we had quite an extensive, we did a lot of work on this during the COVID period. I should say that prior to the COVID period, I would say it was a subject of academic speculation rather than practical reality. But obviously, it did come to the fore, and we did look at it, and it is important that we did and do. It is a difficult tool. It is by no means as efficient as moving positive interest rates around. I think there were a lot of questions about, are there problems just in the basic mechanics of systems? I mean, for instance, do banks have systems that can allow you to enter negative numbers? But also, how's it going to be received by the public? I mean, what's the public going to think about it? I used to say, I can reasonably think the public saying, I thought the whole point of this system was that when I deposit money with you, you pay me a return rather than the other way around. So public perceptions matter. So it is not as effective as a tool as positive interest rates, but it is there. You may come onto this. We concluded that we were still very doubtful about it as a tool.
Can I just join the public puzzlement and just try and understand how it might look in reality, so we can think about what it would mean? Because the immediate reaction is, well, if it's a negative interest rate, then what? I've got to start paying the bank to hold my money.
Yes. Now, I should say that those countries that have used this approach have used it quite selectively, and it hasn't tended to apply to individuals' accounts, and that makes it less efficient too. But I think the simplest way I would put it, your apparent puzzlement at the whole notion of turning the system on its head is one that I would expect if we tried it, the public would probably join you in, and if anything, amplify.
Yes. There've been lots of people queuing up at banks wanting their money out, so they didn't have to pay them to keep it.
Well, except that, therein is an interesting question, because of course the response to that was, where would you go with your money if you didn't have it in the bank? And the answer, of course, is, in principle, is you could ask for banknotes, because banknotes are not interest-bearing. They carry zero interest. Now, in most circumstances, you would say, well, that's not as attractive to me as having my money in the bank. But of course, if interest rates go negative, and if they go too negative, that changes. The question, of course, becomes a rather practical one at that point, is where are you going to store them? How much is it going to cost you to store them, and so on? But it is an option, clearly.
Okay, all right. We may pick that up again when we look at work the bank did to examine that during the crisis, and other work that may or may not have happened since. But going back to quantitative easing, and you having set out that it's really not the optimal way of controlling operating monetary policy, we talked about the time lag in terms of adjustments to the bank rate. Does quantitative easing have a similar time lag? You need to factor in how long it will take for that to ripple out?
Yes, it does. It will have its own transmission mechanism, because it's a very different method of transmission. You're not changing the interest rate on accounts. You're giving, in a sense, you're creating liquidity and giving the option for that to be lent, but you don't know whether it will be lent. So the transmission of quantitative easing is much more uncertain. There is the academic literature is, it's a rich field for academics. It is much more uncertain. And I think it's an important point in this context that we're looking at here. I would agree with people who say that it is, to borrow a phrase, state contingent, but in a way that we understand fairly imperfectly. In other words, the impact of quantitative easing will be quite dependent probably on the state of the economy and the situation that we're in. Another way of putting it is, it may well have a different effect in a crisis to in a non-crisis situation.
Right. Quantitative easing is capable of being reversed, is that right, by quantitative tightening?
Yes.
So that's doing the opposite, is it, essentially?
Yes.
Can we just pick up the downsides to quantitative easing as a mechanism? Is there an inherent risk, or does it have an inherent risk of creating inflationary pressure, or at least the potential for inflationary pressure?
Well, the reason for doing it is that, actually. So, one would do it in a situation where you concluded that inflation was going to undershoot the target, and therefore your aim was to actually bring inflation up to the target. So in that sense, of course, that's the intention of it.
And is that as crude? And I know it'll be much more complicated than this, but if you create more liquidity, there's more money available, then people can access that and spend it.
Well, yes, that's right. It creates the scope for that liquidity to be used, so for lending to happen, for instance, and therefore for it to be spent. That's essentially the transmission mechanism that you would expect.
And is inflation inevitable as a consequence of quantitative easing?
No.
Can you just explain that?
Well, it's not inevitable for a number of reasons. One is because inflation is effectively the outcome of the balance between supply and demand in the economy. So whether a particular action on monetary policy, and this is true of interest rates as well, creates inflation depends upon both how the demand side of the economy is moving and how the supply side of the economy is moving. There are many moving parts in the calculation of inflation.
So just to go back, does that go to your point that its effects will depend on the state of the economy more generally?
Yes.
So you can't say that there is an automatic correlation.
No.
You engage in a round of quantitative easing,
No.
and it will have this
But
inflation
that the same is
effect.
true, by the way, of any movement in interest rates as well.
Yes, it will all depend on the
Yeah.
state of the
Yeah.
economy at the time
Yeah,
you're
yes.
making the change.
Yes.
Right. So the three things, those two
Yeah.
levers, if you're going to pull them, have to be pulled bearing in mind the state of the economy.
Yes.
Right.
Yes.
And presumably, before you make a decision about quantitative easing, you're looking at the state of the economy. Does the bank at least calculate what it thinks the inflationary effect of any round of quantitative easing will be?
Yes, it does. Yes.
Yeah. And does it, or is it therefore able to estimate, depending on the extent of a round of quantitative easing, what it thinks it will do to inflation and when it might do that?
Well, what the bank, we always use forecasting tools as an input to our monetary policy decisions, and that's true whether we're moving bank rate or using quantitative easing. So, in that sense, there's nothing different about the quantitative easing process.
Can we, having dealt with those background issues, move on to a new topic, which is really joined up working as between the bank and the Treasury, and those relationships between the Treasury and the bank. And in particular, I'm asking these questions to understand how you work together with the Treasury during the emergency, whether there are any lessons that can be learnt from how that relationship did or didn't work, and whether any have been drawn. So that's the spirit in which I'm asking the questions. Now, on a personal level, you were new in post in March, the Chancellor was new in post in February.
Yes.
But presumably the two of you, as the heads of those organisations, if you like, had a personal relationship and were in close contact with one another.
Indeed. I didn't actually know Rishi Sunak prior to, well, as you said, the two of us being appointed, actually. But we had a very close relationship. I mean, we were talking daily at the height of the COVID problems.
And the evidence that both of you have provided to the inquiry in writing makes it clear that each of you considered it to be a very positive working relationship.
Very.
Can you just expand a little in terms of why you think it worked so well? Or was it purely personality driven and that you both understood the concepts, or was there more to it than that?
Well, let me come at that in a number of ways. First of all, as you said at the beginning, I've had quite a long experience of central banking, and obviously much of the time we're operating in fairly normal circumstances, and sometimes we're operating in crisis circumstances. At this point, we were operating clearly in crisis circumstances, and I think the bank and the Treasury are institutions that, in my view, I have a huge regard for them in terms of what they do in a crisis. We went through the financial crisis, for instance. I was heavily involved in that, centrally involved in that. So these are institutions that I think are very effective in those circumstances and know how to work together. And I would carry that over into the relationship between Chancellor and myself. I think we're both people who know that we have a duty to the people of this country, and we're going to get on and do it. And I salute Chancellor Sunak for his diligence and his commitment. And I found it a very effective working relationship. We were very straightforward with each other. So people sometimes say, well, does that mean you are compromising independence? And I said, not at all. I mean, I think the people of this country expect us to work together. And we can respect each other's constitutional and statutory roles and the decisions we have to take, and we've always done that. But at the end of the day, it means that we have to be joined up. The public are not going to thank us and forgive us if we don't do that, frankly, and that's always been my view. I think we have a commitment to the people of this country, and I honestly think the two of us went about dispensing it with, frankly, great commitment.
I just want to pick up on that point about independence.
Yeah.
And what you describe as the spurious views of anyone who regards you as having compromised independence by having these close relationships.
Yes.
Because the term you use on a number of occasions in your statement to describe the way the bank, both at your level with the Chancellor and at official level, work together, is that you were working to make sure that the things you were both doing were consistent and complementary.
Yes.
And you've used that phrase a few times.
And it was a very carefully chosen phrase, so thank you for picking up on it.
Yeah. I'd just like you to expand on that a little, because you've made this point that people may think that speaking to each other means we're compromising independence. How should the public really think about this relationship between Treasury and Bank? It is consistent and complementary, really how you would invite people to think about it?
Well, yes. Look, I think we together have a responsibility to the public, to the people of this country, to support the economy and to thereby support them. And never more so than the situation we found ourselves in March 2020. It was an absolute, binding commitment. And we went about, I think, doing that with great, commitment and dedication. What it doesn't mean, let me give you an example where it would be stepping the wrong side of the line. Now, I never had a conversation with any Chancellor which said, well, if I do this much QE, will you do that much over there? Those conversations never happen. We take our decisions independently. Were we discussing in great depth what we were seeing in the economy, how we were interpreting it? There were other areas and you'll see this, of course, in the various statements where we were working closely. Let me give you an example: the COVID financing facility, which we may come on to, which the bank acted as agent, designed and then acted as agent for the Treasury. We were basically, of course, actually working extremely closely together to put that into effect, with a team at the bank working to design it, operate it, but recognising that it was the Treasury's decision as to whether we did it. And that had the full support of me and the full support of Rishi Sunak to say, these are things that we need to do to support the economy and to support the public, and we will get on and do them.
Let's just pick up the CCFF if we can, because generally in the inquiry we've only heard positive evidence about the CCFF. This was a system of providing liquidity funding to very large companies. Yeah. Is that right? That the bank was using its existing architecture to deliver that support at the behest of the Treasury?
Well, let me start with something that we may want to come back to, or we may be coming back to, because it slightly goes back to quantitative easing for a moment. But I'll say there is, of course, another reason why we do quantitative easing at certain times, and that's in crises for financial stability reasons. I'll stop there on quantitative easing and go to CCFFs, but it's important. One of the things that the way that the March 2020 period gets described often and around the world, actually, is the so-called dash for cash. You may have heard this phrase. That was most evident in large companies seeking to build cash reserves in ways that we had really never seen before. So probably the best statistic I can give you, I think, is that I think the drawdown of cash, which mean using things called committed borrowing lines, for instance, by large UK companies in March 2020 was 30 times the monthly average of 2019. By the way, you get exactly the same story if you look at the US, for instance, and other countries. This is an extreme position to be in. And it was clearly driven by fear that the economy was closing down and that they were in danger of insolvency unless they could liquefy as much as possible. Now, that puts extreme stress on the banking system and extreme stress on the economic system. And so we had to design as many useful tools as we could to respond to that. And the CCFF was one of those. And I'm very proud of the CCFF because I'll give you the storyline, actually. I mean, the afternoon, Sunday the 15th of March, the day before I started my term, I mean, it had to be very clear that Mark Carney was the governor until that evening, midnight that evening. And by the way, the central bank swap lines were done literally at 10 o'clock that evening.
So he walks out with his cactus in a box, and you move.
Well, we did them together, but I had a call with the senior bank staff on Sunday afternoon, and they sort of put it to me, have you got what you need for tomorrow? Because it's looking a bit hairy. And I said, well, the thing that worries me is that we've got this extreme cash demand going on in the company sector, and how if this goes further, we've got trouble. Big trouble. And that was really the origin of saying we need another tool targeted at big companies. And literally that afternoon, we had the first conversation on the CCFF. I think we took it to the Treasury, I can't remember, it was Monday or Tuesday, so the next day or the day after. We launched it the following Monday, and I think the first companies were starting to go through the process by Wednesday. So that's 10 days.
And we've heard evidence there was a nil loss rate from the CCFF.
That was nil loss rate, yeah.
So,
and our staff were extremely innovative because, many of the companies didn't have public rate. There was a credit assessment process, and many of the companies didn't have public ratings. So we had to, in a sense, obtain and create processes that mimicked that to make sure we could get to where we wanted to get to.
And so, Mr. Bailey, you would say there is a really clear example of this, as you put it, consistent and complementary.
This is the Bank and Treasury. Honestly, this is the Bank and Treasury at their best working together, to solve a problem.
But never that line being crossed of the chance of saying, can you engage in some QE so that I can spend some money here or things like that? That's the line as far as you're concerned.
Absolutely.
Of independence.
Yes.
Yeah. Okay. You mentioned, and I just want to pick up on this briefly, about the Chancellor and yourself and officials presumably having conversations about the state of the economy.
Yes.
Were you sharing data and analysis as between the bank and the Treasury, and were you finding it was coming both ways?
Yes, very much so. So to give you a few, I think, key examples there, we moved very quickly to put into place access to and processing of high-frequency data. The bank had a bit of a sort of leg up on this because they had put into place a monitoring system when Brexit was implemented to use mobility data around ports to track heavy goods vehicles to get a much more immediate sense of what the effect on trade was. And so we were able to, in a sense, take that bit of machinery and build out from it and incorporate things like mobility data, transport data, restaurant bookings data, payments data, which we tend to have access to, but we extended that a lot, to build a much more sort of short-term immediate picture of what was and more particularly what wasn't happening in the economy. And then working with the Treasury, we got input from Treasury, we got input from the ONS on that. And that was very useful. I mean, I certainly was, looking at that every day to say, well, what are we seeing and what are we not seeing? So that's, I think, a very good example. I then remember that, there was obviously a lot of uncertainty about what the impact on the economy was going to be. We'd never had the economy go down to lockdown in this way before. There was a lot of speculation. I remember that it was going to be the biggest fall in activity since the Great Frost in 1709 or whatever it was, I don't know. I mean, that's interesting as a sort of, it's almost a sort of trivial pursuit fact, but it's not going to be terribly useful for the analysis. But we were in extreme circumstances. And then there were also big puzzles in the data. I'll give you one, which I'm sure, Rishi Sunak may expound on, because it was a big, and that was public sector output. So the UK has a rather different way, for instance, of measuring output in the health service, in that it actually tries to count the stuff that happens and then to convert that into economic activity. Perfectly reasonable thing to do. I think the more traditional way is just take the amount of spending and deflate it by an inflation number and get real activity. But the problem was that the stuff that was being counted in normal times wasn't happening. And so it looked like output in the health service was actually coming down a lot. But of course, this didn't really, this wasn't true, clearly, in the sense that, the health service was working, incredibly hard and incredibly well. And it was a great source of frustration to both of us that, we just couldn't seem to get the reading of what was going on. So of course we were then trying to say, well, how can we get alternative ways into this question? So, long answer, there was a huge amount of work going on data.
But it sounds from your answer, and I don't apologise for it being long, and thank you, by the way, for actually slowing down. I said I've asked.
Is that okay? Right, good.
I've asked a lot of witnesses to do it. I think you're the first one who actually has, so thank you for that. But it sounds like it was a very collaborative relationship in terms of sharing data.
Yeah.
And generally, so I just want to pick up on that. If you take the personalities out of it, there's always a danger that you just happen to have two people who get on. But if you took the personalities out of it, structurally, did you have any concerns about how Treasury and the bank engaged? Are there any lessons that can be learned, or new structures that are required in your view, or do you think things worked as you would have hoped and expected they would in terms of that relationship between the Treasury and the bank?
Well, that's a really interesting question. Really interesting. I've worked with the Treasury 40 years now. So we worked, of course, as you imagine, extremely closely together on the financial crisis. I'm not the first person to say this, that if you go back in history, bank-treasury relations have been sort of interesting at times. I think some of the issues in the past, if you go back before the reforms of 1997, were that the roles were ill-defined relative to, well, particularly the bank's role actually was ill-defined, say monetary policy, for instance, relative to what they are now, and the same was true to a considerable degree of financial stability. But I'll be honest, I felt coming in as governor that, and this is not to do with COVID actually, interesting, this was before COVID came along, that we needed to work on, frankly, the bank's relations with the outside world at times, and the Treasury was part of it. My objective, what I wanted to do when I came in as governor, and I'd gone on doing it, by the way, but COVID disrupted it. I'll give you the sort of the tagline was what I called human and humble. This is a phrase we've used in the bank, to say that I don't want to compromise our independence and our quality of our work, but frankly, I think the bank can improve the way it works with other organisations. And it's been an objective of mine. I think we've made progress. And COVID, in a sense, did, if I'm honest, disrupt that in the sense that obviously the impact of the remote working, but actually it gave us on the other hand, it gave us a very focused case study to actually work on, and I think it went well.
One of the things Lord King touched on this morning was, in a slightly different context, but I think it may be relevant to what you're saying, is this danger that as central bankers you tend to hang around with other central bankers and academic economists, and there's a sort of sense of groupthink can develop. So the institution just thinks as an institution, and there isn't that engagement, and therefore challenge that engagement can bring. Is that what you were trying to break down a little bit with this? Was it human and humble as the...
Well, partly, although, I mean, let's be honest, the Treasury have been accused of groupthink as well, so I'm not sure I would, if I'm put my hand on heart, I'm not sure talking more to the Treasury only gets you past the point that Mervyn King was making.
But more generally, do you accept
Well, let me
that?
I'm happy to address that question. I think, and I think he agrees with this because we've talked about it many times, and it's in his evidence, in his written evidence to you. I think the economics profession is open to that challenge over the long course of history, in the sense that you get sort of waves of thinking in the profession. I mean, they're always a bit sort of exaggerated and a bit sort of caricatured, but, people talk about Keynesianism and monetarism. Those things are, I mean, they're too high level to be useful as tags many ways, but it is true that I'm sure it's not the only academic profession where you get these waves of sort of thinking that sort of take over the discipline. And central banks are part of that. The thing that I would say, because I've talked to Mervyn about this many times, and I've heard him say it. I mean, I would say this: if you look at the voting record of the Monetary Policy Committee, we're not. I can't even remember the last time we were unanimous. So it's not a committee that I think has that natural tendency. And I've actually, I don't encourage people to vote, randomly, obviously, and I don't necessarily encourage people to vote against me, but I've always said, look, I think where we hold different views, we should set them out to the public transparently. So I don't mind if people vote differently in that sense.
And it's my fault entirely, because the interesting discourse we were having took me slightly off the point I was trying to make with you. But can we just go back to this relationships with the Treasury? And I think I'd asked you whether you thought the structures were appropriate to enable that important dialogue, or whether any further change is required or has been undertaken in terms of how the Treasury and the bank work together.
No, I think the working relationship was very good. I mean, I think COVID, for me, pointed to a few areas where, the system creaked a bit more. I mean, look, I think, and I don't particularly fault anything for this, because, you can sort of plan for many things, but not everything. There were a few areas, going back to your point about data, where there were restrictions on access to data that were embedded in law. I think a number of us have referred to these in our written submissions, where it would have been nice if we could have, it would be nice if we could have got into the sectoral data that the government has, but the law says that they can't share it. I think it would be helpful if we could get more easily sight of things like universal credit data. I mean, we don't want to know who it is. This is aggregate data, obviously. And then I think the whole area of interlinking and sort of drawing the sort of wisdom out from putting health data together with economic data was something that we hadn't put a lot of work into. Now, let me say on that one of the most valuable things that we had access to, and I want to put on record my huge thanks to him, was the briefings that Chris Whitty gave us in the Bank of England and for the committees. I mean, absolutely invaluable. But he and we continue to talk about it, actually, because there are puzzles today, many puzzles today, actually, that persist. I don't think we've still done enough to say, how can we sort of put the economic data and the health data together and, get better wisdom out of it. So I think that's an area that I would point to.
So access to more data that government holds on an aggregate basis, because that will enable you to see in more real time the effects on the
Yeah, I
economy,
mean, I think in the best, at least in the best world, if there would have been in the law a provision for somebody to say we're in a crisis, we can flip a switch, and yes, you can have the data in this situation.
Yeah, understood. And then try and build systems through which you can integrate it.
Look, I don't want to suggest that it would have produced particularly different outcomes, but it would have been good to be able to see it.
Yeah, okay. Can I make a start on the next topic area before we take the lunch break, which is the nature of this economic shock, and if you like, the novelty of this economic shock that COVID presented. And one of your jobs as governor, and you can tell me whether you agree or disagree, Lord King put it like this, that the main job of the Monetary Policy Committee is to assess the nature and scale of any economic shock. But your job as governor, certainly, you agree with that?
Very much so.
As a proposition. And the impact on demand and supply, and he spoke about how monitoring is so important. And he drew a point that most data that the bank has access to relates to demand very often rather than supply. But going back to the nature of the shock, this was unfamiliar, do you agree, in terms of its nature and its scale?
It was unprecedented.
Yeah. And one of the things that made it unprecedented was this was a shock to the economy arising from outside the financial system.
Well, it's partly that, and it's partly there is really no precedent for sort of deciding to close the economy down.
No. Because this was about the measures that were being taken to combat the virus on a health basis.
Yes.
And so that, presumably, the fact it was unprecedented means there was no example you could go back to. There was no. There was more uncertainty. Is that fair?
Yes. Oh, huge uncertainty.
Yeah. And did that make assessing the shock and how it might affect the economy more difficult?
Oh, yes. I mean, obviously, our line of sight was hugely impaired.
And how did that line of sight being impaired affect your ability, the bank's ability, to calibrate the appropriate monetary response?
Oh, it had a substantial effect. Let me say two things on that which are important. First of all, the response that we made immediately in my first week as governor, the big intervention we made in that week, was as much to do with financial stability as it was to do with monetary policy. That's important because there's a whole other side to our activity, which is financial stability. And the judgments we had to make, had to take that very much into account. But going forwards, you're right. We obviously were working with very, much an impaired line of sight. And the second point I'd make is probably the best example of that I can give you in practical terms is that when we produced the monetary policy report, the quarterly monetary policy report in May, we did not, for the first time in the MPC's history, include a forecast. We had what's called a scenario. I'll explain the difference because you may say, well, that's a bit subtle, isn't it? But it's important. The forecast, and I don't want, because like Mervyn King, I don't want to overstate the role of this forecast in our decision making, but it is central in the sense that it is our best view of what we think is going to happen to the economy. Now, we didn't have that line of sight to give that. The scenario is a bit different. The scenario is saying, if the following things were to happen, here's our sort of best line of thinking at the moment on how that would, if you like, pan out. So it's a different thing. It's not saying this is our best view of what will happen. It's saying if this were to happen, and we think the if has been constructed with the sort of best line of sight we have today. Putting together our knowledge of how sort of things fit together in the economy, it could turn out like this, but we're not putting anything like the degree of confidence on it that we would normally do.
And that perhaps illustrates the great degree, the great level of uncertainty.
Yes, it does.
Right, thank you.
It does.
Well, I think that is 1:45, so we have to take our
Okay.
break there, Mr. Bailey. My lady, is that a convenient moment?
Cheers, Mr. Wright. I'm sorry we've got to break off, Mr. Bailey, but I promise you that we will
Not at all.
finish you this afternoon, probably by 3:00, I think.
That's fine.
I know how busy you must be.
Quite
I
understand.
shall return at 1:45.
Fine.